Hello friends, this is the story of most of us. No matter how hardworking and committed we are, if we don't go to work for even a single day, we won't earn any income that day. Our financial situation doesn't allow us to rest, and we remain trapped in this rat race for our entire lives. Despite wanting to, we can't escape this cycle because it has become a part of our needs and responsibilities. However, with time, the new generation is becoming more financially aware and wiser than ever before. Along with this awareness, they are beginning to understand that working hard all your life and living an average life until old age is not the true way to live. This is why most of today's generation is focused on achieving early retirement, passive income, and financial independence. As a result, people are showing interest in investing in the stock market because they know it's the path that can lead them to financial freedom. But the problem most people face is how to choose the right stocks. This is a big challenge because the real game of investing is buying the right stocks at cheap prices. This is where author David Solomonides teaches us an investment method that helps us tackle this challenge. This method is based on the principles of value investing, common sense, and basic discipline. The main goal of this method is to build a portfolio of stocks that not only gives you good returns but also ensures that your passive income grows steadily over time. The Falcon Method is named after the falcon, a bird known for its expertise in catching prey. Similarly, the Falcon Method works in the same way. The author, who faced significant financial struggles during his teenage years, decided early on that he didn't want to get stuck in the rat race as an adult. He shares that through this method, you can create a well-thought-out portfolio that ensures not only financial security but also financial freedom. In this book, the author shares his own strategies and experiences, which can be extremely useful for both new and experienced investors. The first principle of the Falcon Method is value investing, which focuses on selecting stocks that are undervalued, meaning their market price is lower than their intrinsic value. By choosing such stocks, you can expect good returns in the future. The second principle is common sense, which is the most important trait for any investor. The author explains that you don't need extraordinary intelligence or specialized knowledge to succeed in the stock market. Rather, you need to use your common sense effectively. The third and final principle is discipline. Controlling your emotions and sticking to your rules is crucial in the stock market. The Falcon Method emphasizes the importance of discipline because your success in investing depends on your patience and discipline. The Falcon Method is a simple yet effective investment strategy that helps you choose the right stocks, build passive income, and achieve financial freedom. This book is useful for anyone who wants to secure and liberate their financial future. So, if you also want to break free from the rat race and live a secure, independent, and happy life, adopting the Falcon Method could be a great step for you. David Solomonides achieved financial freedom and retired at the age of 33. Born in 1982 in Hungary, his parents divorced when he was just 10 years old, and he lived with his mother, who was a kindergarten teacher. During his youth, David faced various financial realities that forced him to decide that he wanted to achieve financial independence as early as possible. This decision motivated him, and with his capability and passion for learning, he became financially independent by the age of 33. Today, David is a full-time investor, and his book, The Falcon Method, teaches us that the stock market is a field where we can start with very little and achieve financial freedom. Over time, your money will work for you instead of you working for your money. David's story and his book demonstrate that with the right investment strategies and determination, anyone can achieve financial freedom and live a comfortable life. In 2011, Warren Buffett, one of the greatest investors in the world, wrote a letter to his shareholders in which he explained the three main types of investments. The first type is currency-based investments, which include bonds, bank deposits, and other safe investment schemes. Investors consider this type of investment the safest, but the reality is that it's not the best option. The main drawback is that the interest earned on these investments is often lower than the inflation rate, meaning you could end up losing the value of your investment over time. The second type is unproductive assets, which don't generate any income until you sell them. These investments don't contribute to productivity or help grow your wealth. The third type is productive assets, which are considered the best form of investment. The stock market is a prime example of this category. Warren Buffett advises investing in productive assets because they can provide good returns that outpace inflation. The biggest advantage of productive assets is that you can start with very little capital. When you buy a share of a company, you're buying a small ownership stake in that company. By staying invested in the company for the long term, you can earn good returns on your capital. When the company makes a profit, you, as a shareholder, also benefit. Therefore, to succeed in the stock market, it's crucial to invest in good stocks and hold them for the long term. With productive assets, investors can not only beat inflation but also earn good returns on their capital. This type of investment can be highly effective in growing your money and strengthening your financial position. The goal of the Falcon Method. The Falcon Method advises adopting a buy-and-hold policy in the stock market. This is completely different from the old quant model, where you use quantitative methods to buy the best stocks, hold them for a year, and then sell them. After that, you conduct new research, buy the best stocks again, and sell them after a year. This process is repeated every year. The quant model's process is not comfortable for an investor. You might end up buying stocks of companies you've never heard of. A major disadvantage of this approach is that sometimes it takes more than a year to see the results of a company's plans. If you sell the stocks within a year, you miss the opportunity to be part of the company's growth. In contrast, the Falcon Method suggests selecting high-quality stocks and holding them for the long term. This way, you can earn consistent dividends from the stock over time. Through buy and hold, investors can generate significant returns. The main goal of the buy and hold strategy is to purchase high-quality stocks and hold them for the long term. This approach allows you to be part of the company's growth and success. When you hold a good stock for the long term, you can benefit from the company's growth and earn consistent dividends. Thus, the Falcon Method's buy and hold strategy teaches investors to invest only in quality stocks and hold them for the long term to achieve good returns over time. This approach is ideal for stable and profitable long-term investments, protecting you from short-term market fluctuations and leading you toward a solid financial future. The 5 strategies of the Falcon Method. Select a group of top-quality companies. The first step in the Falcon Method is to select top-quality companies. Focus on companies that have consistently paid excellent dividends to their shareholders over the past 20 years. This indicates that these companies have maintained stability and high quality over time. The author advises never to compromise on a company's dividend history because a 20-year dividend history shows that the company has faced one or more recessions and still maintained its dividend payments. This is a strong sign that the company has a solid foundation and can withstand economic downturns. The author suggests selecting companies with a high dividend payout ratio, as this indicates that the company is returning a large portion of its profits to shareholders, which is a great sign. Buy at the right time. Another important strategy is to buy a company's stock only when it's available at a cheap valuation. You need to carefully check the company's price history and calculate its average low level. This process helps you understand whether the stock's price is near its historical low. When a company's stock is trading at its average low level, it's a great entry point. Buying at this time is ideal because you can make a good investment at a low price and expect higher returns in the future. On the other hand, avoid overvalued stocks, as investing in them can lead to losses and limit your potential returns. Filter the shortlisted stocks. Once you've selected top-quality stocks and identified the right time to invest, the next step is to filter these stocks based on 3 key metrics: dividend yield, free cash flow yield, and shareholder yield. Dividend yield shows the percentage of the company's current share price that is paid out as dividends annually. A high dividend yield is a good sign, indicating that the company is providing a good return to its shareholders. Free cash flow yield is calculated by dividing the company's total cash flow by the total number of shares to get free cash flow per share, and then dividing that by the company's current market price. This metric shows how well the company is managing its cash. Shareholder yield shows how much the company shares with its investors, either through dividends or share buybacks. A high shareholder yield indicates that the company is providing good returns to its shareholders. Rank the survivors. After filtering, rank the selected stocks based on their current valuation. The top rank includes stocks that are available at a better price than their average valuation. These stocks should be your top priority as they offer great opportunities at low prices. The second rank includes stocks that are trading at their average valuation. These stocks require careful consideration and further analysis. The third rank includes stocks that are trading well above their average valuation and are expensive. Avoid buying these stocks as they are overpriced and may provide lower returns. Take the leap with qualitative judgment. After completing all the analysis, you'll have a portfolio of high-quality stocks. The final step is to hold these stocks for the long term. The goal of the Falcon Method is to buy quality stocks and hold them in your portfolio for the long term. This way, you can achieve excellent returns in the stock market and create a passive income stream. By holding quality stocks for the long term, your money will continue to work for you even when you're not actively working. Conclusion. We've now covered all the key principles and strategies of the Falcon Method. This book provides valuable insights into achieving success in the world of investing. By adopting this method, You can not only improve your financial situation but also become a consistent and self-reliant investor. As we've seen, this method emphasizes thinking long-term, investing wisely, and continuously updating your knowledge. By following this approach, you can reduce risks and increase the potential of your investments. If you found this summary of the Falcon Method helpful, please like the video and subscribe to the channel. Don't forget to share it with your friends so they can also benefit from this valuable information. Thank you.